Good morning and welcome to our latest virtual roundtable brought to you by Bridging and Commercial and kindly sponsored by Ortus Secured Finance. Thank you very much for joining us this morning. My name is Beth Fisher, editor at Medianett, the publisher of online titles Bridging and Commercial and Development Finance Today and the bi-monthly print Bridging and Commercial magazine. Today, we will be discussing how the UK real estate market is performing across all sectors and key trends to watch. In June, we saw annual house price growth to 13.4%, the highest level since November 2004. With the stamp duty holiday fueling transactions in the race for space, Nationwide's house price index reported that every region in the UK saw an uptick in UK annual growth. Northern Ireland was the strongest performing, with prices up 14%, while Wales also had its largest rise in prices since 2005. In contrast, Scotland saw a modest rise in annual growth, making it the weakest performing part of the UK. Yorkshire and Humberside was the strongest performing region in the UK, with London having the least growth. While yesterday marked England's Freedom Day, it will be interesting to hear from our panel today on whether differing policies, including the end of government support in all regions, is impacting investment and brokers and lenders' ability to assess deals. We will also be looking at how key sectors are changing in all regions. The high street, a huge driver of economic growth, jobs and innovation across the UK, will undoubtedly change as pointless red tape is removed and requires innovative thinking from investors and lenders alike. We will likely see empty shops repurposed into homes, restaurants or new types of entertainment and leisure destinations as city centres adapt to customers' changing needs. While cities lose swathes of custom, the pandemic has resulted in a much bigger appreciation and footfall for our local areas, satellite cities and suburban neighbourhoods and towns. With many employers embracing hybrid working and a huge shift in commuting trends, Friday after work drinks, for example, could be replaced with employees spending their Friday evenings in their own local areas with friends and family. While walking around city centres still feels quite deserted compared to pre-pandemic, town centres and their businesses in staycation hotspots have seen a welcome boost. We hope today's discussion will explain how different regions are reacting to new requirements for commercial real estate, especially considering it's still early days, and how new patterns of working, living and vacationing are impacting both city centre and suburban real estate assets. Joining me today are a fantastic group of experts in the market who cover London, Northern Ireland, Manchester and Scotland real estate markets. So now is the perfect time for me to hand this over to them, who will each spend around 2 minutes introducing themselves. And I'd like to start with Jon, please. Oh, maybe we won't. David?
Okay,
all right.
I assume you mean Jon Salisbury. I'm very sorry for those of you that can't see me, which I think is everybody. I'm having some webcam issues at the moment, so really many apologies for that. But I'm Jon Salisbury. I'm here. I can see everyone and hear everyone. I'm the MD of Ortus Secured Finance. We're a lender, as hopefully everybody listening to this knows, and somewhat unusually in our sector, we have offices throughout the UK, and that sounds rather more glamorous than it really does. It really is, I suppose. We have offices in Scotland, Belfast, Manchester and London, and for that reason we thought that this was an interesting theme to follow. We track the different areas really closely, and that's why we have such a good network, which has been kind enough to join us on this call of property experts throughout the UK. Our view is that it's good to be local in the areas that you're lending in, which is why we've always followed that strategy, and it's now become one of our guiding principles. So along with my colleagues, we run a lending business where we're looking at all sorts of properties across the UK. We lend over residential, commercial, industrial. We have some land. So it just seems like quite an apt lender, being us, and also an apt theme at the moment, because as you said at the beginning, it's quite interesting trends across the business. So that's about us, and that's about the reason why we've chosen this particular subject for our webinar.
Perfect, thanks for that, Jon, and hopefully we will be able to see you soon. We definitely hear you loud and clear, so that's not a problem. David.
Yes, thanks, Beth. A good introduction by Jon, so I don't need to talk too much about Ortus. I'm an associate director in the lending team. I've been at Ortus for 5 years now, nearly 5 years, and I think some of the principles that Jon talks about there have sort of been fundamentals of ours, you know, throughout that time that I've been at Ortus. My role typically is seeing new transactions from start through the legals, through valuation, all the way to getting the money out the door. My background is as a chartered surveyor. I used to work at Colliers in the restructuring team, so I have my own valuation experience, some agency experience and property management experience, which hopefully I've been able to bring to the party at Ortus, and particularly when it comes to you know, considering valuations, speaking to the guys that we have on this call, interpreting and using their expertise to make lending decisions. So that's sort of my input from a surveying background into the business.
Thanks for that, David. James?
Yeah, I'm James Cunliffe at Strutt Parker. I'm a chartered surveyor and I specialise in the residential sector, predominantly in the prime central London markets. We act predominantly for many banks, lenders, and particularly with the private wealth banks. So generally the assets we look at can be from sort of 2 million up to going sort of well north of 50, 100 million for an asset, depending on what it is and where it is. And yeah, that's my background. So very much on the residential side. We go as far as that I work in the home counties as well as central London.
Thanks for that, James. And Jason?
Hi everyone, I'm Jason Thompson. I work Savills in their Northern Ireland office. You know, we're a multifaceted commercial business. We've got the divisions of management, commercial agency, capital markets, and valuation and professional services. I'm a director and head up the valuation team. 20 years experience in Northern Ireland. Undertake commercial valuations predominantly across the various sectors, also portfolio residential valuations. My background prior to joining Savills, which I've been in for 6 years, has been PwC for 6 years. Before that, as an asset manager dealing with the deleveraging of the challenged portfolio, which is 250 million pounds worth of assets for the local banks. So it was great to be able to see that side of the market when we were just coming out of the last recession. But I'm overjoyed the fact that the market has bounced back over the past 5-6 years when I joined Savills, and I'm glad to say it's in a healthy situation now.
Brilliant, thanks for that. Andy?
Hi there, I'm Andy Clark. I'm a valuation director in Colliers based in Edinburgh. Yeah, 20 years experience of doing valuation work in Scotland, so cover all the main sectors, also assist our specialist teams with some of the more specialist properties. We've got a full service team in Scotland as well, so can cover all the various needs that are required. Yeah, we act for all the main high street lenders, funds, developers, private individuals, valuations for tax purposes, so the full kind of scope. I'm also quite pleased to see the markets bouncing back. It's nice to see some activity and some deals and some evidence to base our valuations on. So it's good to see Scotland in the right place.
Perfect, thanks for that, Andy. And William?
Thank you, Beth. Yeah, my name's Will Biggin. I'm also a director in the Colliers valuation business, and I run the Northwest valuation team based out of our Manchester office and occasional trips to our satellite Liverpool office as well. I've been with the business for 14 years now and have been working as a valuer in Manchester and the Northwest for about 20 years, providing predominantly valuation advice to main lending banks on the main commercial property classes, office, industrial, retail, but I do advise on residential development and some residential investment portfolios as well. My view is that, and I'll give the Northwest a minor plug here if I may, that Manchester is now very much a mature and internationally recognised city and is really the hub of the Northwest region, very attractive to domestic and international investors now.
Brilliant, thank you. So that's everyone, and it's nice and refreshing to have an array of accents on the panel. So it's definitely interesting to hear what all of these regions are experiencing at the moment. So I'm looking forward to hearing your opinions, especially with the questions we've got for today. I just want to remind our audience that if you have any questions for our panelists throughout, please do ask in the chat box on the right of your screen. I will be asking those questions in the last 5 to 10 minutes of today's discussion. So please do ask if you've got any burning questions. Okay, well, I'm gonna kick this off just kind of based on the figures that I was talking about earlier, which was showing the house price surge in the UK, where we saw areas like Northern Ireland and Wales seeing the strongest gains, while Scotland and London were seeing the weakest. It would be interesting to know from your point of view what is underpinning these regional differences and how it's affecting lending decisions. David, should we start with you on that one?
Yeah, I think it's an interesting one, isn't it? And I think the challenge will be understanding what habits are permanent and what habits are sort of short term. And I think for sort of London, there are obviously various different sort of price categories, I guess. And certainly from my own experience, we were chatting before the call about, I'm one of these people who has sort of vacated London out of the flat in search of more space, and inevitably that's moving out of somewhere like London. Equally with areas like Northern Ireland, I remember speaking to Jason quite a few years ago, and we were talking about increase in house prices back then. And it's continued to do so well, and that's why Northern Ireland has been such a good market for us, that we got in at a good time. We associate ourselves with good professionals like Jason, who has that sort of intel. And obviously, if you've got good fundamentals in areas like Northern Ireland, where you've got guys who can actually afford mortgages, house prices are attainable in those locations, then it makes more sense to sort of lend there if you've got good fundamentals. Is that fair, Jason?
I think that's entirely correct, David. I think what is fueling the growth in Northern Ireland, as it is probably replicated across the rest of the UK, is you've got the perfect environment where you've got low interest rates, you've got low inflation at the moment. In Northern Ireland, well, certainly pre-COVID, you had reasonably good job security. You had a very good skilled workforce in Northern Ireland. 25% of our population, in terms of the workforce, actually works in the public sector. So it's a very good dynamic to have to consistently fuel the growth. I think what Northern Ireland always suffered from was a lack of new build stock. In 2016, the housing growth indicators, the HGIs as they're known as, they set the targets for, I think it was 860,000 homes in Northern Ireland by 2030. In 2016, they only had 775,000. So over that period, they had to seek to build something like 85,000 new homes. And that was running at an average of about 6,000 homes a year. They fell short of that coming up to 5 years ago. It's only in the last sort of 2 or 3 years that they've managed to gather pace above that average 6,000 a year. And I think during lockdown, the construction industry obviously can't work from home to build houses. So they were one of the first industries that came back into the sector. And they continued on with the program of trying to meet these HGIs and trying to meet the target by 2030. But as a result of that and the pandemic, it has absolutely fueled a housing boom again in Northern Ireland, as we heard from Beth with the figures. Our average house price has increased about 4.5% over the last 4 to 5 years, and that's brilliant to see. I think our market really is strong at the moment, and long may it continue.
Jason, are you seeing more lenders kind of enter Northern Ireland? Because before it was quite a niche, especially for Ortus, and it'd be interesting to see if you've seen more demand from lenders in terms of the supply there, and also brokers entering that space.
Yeah, no, I think you're right, Beth. These sort of growth indicators create opportunities across various sectors, and the banking sector has picked that up and ran with it. We have seen 2 or 3 new lenders that we haven't worked with before that have come into Northern Ireland, trying to fund in terms of residential buy-to-let portfolios, where we wouldn't have any visibility in that space. And through speaking to them, it's not that they've necessarily been using other valuers as such. It is a fact that they're competitive in terms of their rates on the portfolios. Perhaps their LTV, their loan to value ratios are attractive to some borrowers as well. And I think certainly in Northern Ireland, from a regional perspective, the fact that the stamp duty holiday on residential that's due to be phased out from July now until September, again, is fueling people trying to complete on new homes purchases. And we've certainly seen a massive increase in investors and developers looking to buy-to-let portfolios before that stamp duty window closes in September.
And to move to the Manchester region, every time I go up to Manchester, there's always a new development, or there's a lot going on in terms of building. Well, what do you think is underpinning regional kind of differences there in terms of house price growth and investment?
Yeah, I think you're right. I take a tram journey on a regular basis out to Altrincham, and I have been doing that journey for about 20 years now, and the scene is very different, almost month on month, as new towers come out of the city centre, driven by build-to-rent investors and funds really clamouring to get a piece of real estate in the city centre in their portfolio, but also developers now moving out into the suburbs, building build-to-rent in more traditional family housing as well. So locations like Stretford, that 5-6 years ago wouldn't have been an attractive location in South Manchester and part of Trafford, developers now really seeing that as a really good location to build traditional family housing for sale and also for rent. And I think one of the main reasons for the development in around Northwest, particularly around Manchester and Liverpool, are the city's connectivity, their infrastructure, their internationally recognised airport, and businesses which have moved out of London, organisations which have moved out of London, for example, the BBC, really creating employment opportunities for younger talented staff that now see Manchester as a real alternative to London as a place to build a career. And that is borne out by the evidence of the retention of the universities retaining over 60% of their graduates now, whereas before they would have bled those out to the capital. So it's really about infrastructure, employment opportunities, and affordability as well when you compare it to living in the southeast.
Thanks for that, Will. I also mentioned earlier about London reporting the weakest in England in terms of house price growth recently. James, what are you currently seeing in London? Keeping in mind that we're seeing this race to space and people moving out. David mentioned that earlier. I also did the same, and know many that have moved away from city centres. So how has investments changed and in central London?
Yeah, well, Beth, you're absolutely right. There's definitely been sort of a move since the pandemic, people wanting more space, wanting more gardens. I think taking the view that they'll probably spend less time in the office in London, working part-time from home. So there's definitely been a drive out of London. I think surprisingly, the London market's held up very well, considering that the London market is much more reliant on overseas buyers coming into the market. An issue we've had is really with the travel bans, and we made that very, very difficult for people to come across. It's not a homogeneous market, the London market, and I think what we have seen is, for example, areas which are probably a bit more domestically driven, so Notting Hill, Kensington, Chelsea, particularly the houses have performed very well. I think to new build flats, etc., reliant on investor and overseas investor market, it's definitely been a bit more challenging. But actually what we've seen certainly in the prime central London market is that prices have pretty much held where they were through the pandemic, which again, with the lack of overseas buyers is I think a lot of people say would be quite surprising. But I think it does underpin the strength of the London market.
Thanks for that. We mentioned a bit earlier, or Jason mentioned, you know, we were seeing some new lenders enter Northern Ireland, for example, and regional expansion has been a big move over the last couple of years from lenders looking to take a bit more market share and enter new niches. But are differing policies towards the pandemic hindering lenders' ability to expand regionally? Jon, if you're there, it would be great to hear your thoughts on that one.
Yeah, I'm here, getting very angry with my webcam, but I'll stop going on about it. I think that I can't speak for other lenders, and I know you wouldn't expect me to do so. What I would say is that going from an Ortus perspective, going regionally is about knowledge, and it's about understanding where it is you're going, and it's not something you do lightly. It's not cheap, it's not easy. And when we went into Northern Ireland years ago now, we did our first deal there in 2014. Richard, Beanstalk and myself had been back and forward from Northern Ireland countless times before that to get comfortable, build the network around us, and that network has stayed really tight since. So I've known Jason now for years. There's a really close relationship between Ortus and Jason specifically, and Savills. There are a few others as well that we know very well, and you've got to feel like you understand your market to the best of your ability, and that you're partnered with people who have got it sort of stamped through them, and they really know their stuff. Same with Scotland. So going regionally, it's a really good way of breaking into a new market and picking some low-hanging fruit. There's no doubt about that, and that's why people get tempted into a new market where they say, "Oh, I'm maybe struggling for a bit of deal flow," or, you know, "I know what we'll do. We'll go into this market because then we'll get a load of deals." Yes, you can and you might, but it's also very risky. And you've got to do it carefully. You've got to do it slowly. You've got to speak to people who really know what they're doing, because, you know, if we all think about our local markets where we live or where we grew up, and you can talk in such intricate detail about this street versus that street, you know, the sorts of people that buy there, the sorts of risks associated with it, the thing that happened 5 years ago that really matters in the local market but somebody coming in might not know about. And so it's really difficult, but it's something that we're seeing. It's something that we certainly where Northern Ireland's concerned, it's something that we really welcome, because as a lender, going into an area and being one of only a few, again, is risky, because you need people that are going to refinance you. You need an active market. You need clients to have other options. You need it to be generally healthy. And it was when we went into Northern Ireland, but it was tend to be hard work. And we've seen some great lenders move into Northern Ireland. Some have come and gone. Others have become really established. All we've done over there is grown. It's been a really good thing. And actually, the challenge for us now is to be more active regionally in England. So we have an office in Glasgow, and we have Scottish people running that office who really know their stuff. Colin Anderson has been around for decades, hugely experienced guy. Obviously, Northern Ireland, we've got a really experienced team over there. And we have our team in London, and we have Richard King based in Manchester. We're light regionally in England, so that's where we see a really big opportunity for us.
Fantastic, thanks for that, Jon. It's definitely, you know, important what you mentioned there. You know, relying on knowledgeable third parties, and also having that expertise across the various regions, to make sure that they know their local areas. And David, how much do you rely on local knowledge of your team members and third parties?
Yeah, hugely. I think what Jon said is absolutely right, and the interesting comment he made was about sort of having those discussions when you talk about areas that you know in detail, and undoubtedly, you know, when we're having, you know, a credit call, we're discussing deals, you know, it's fairly frequent that somebody will pop up with a comment specific to that area. I know this area, I've come across this borrower, whatever it may be, and those are that's really important intel for us, and can often make a difference as to whether we decide to do it or not. But likewise, you know, we can't know everywhere ourselves, and that's where you do rely on the guys with the intricate knowledge, because you know, the old adage of location being so important, it's absolutely true, but within that location there are lots of micro locations, and it's important to have good intel on those areas. I think something for me, for example, that I've seen during the pandemic that I probably didn't realise is an area such as Cornwall, which, you know, I haven't spent a lot of time there, because traditionally for my holidays I like to get on an aeroplane like many people and go overseas. And I think what we've seen during coming out the back of the pandemic is some really great operators in areas like Cornwall. Well, if we don't know it, we need to speak to the right people in those locations that will give us that intel, and we can feel that will pick up the phone to us, not just put numbers in a valuation report, but will pick up the phone to us and say, listen, this is a fantastic area because you've got this in the area, you've got that in the area, and that's been invaluable to us, and you know, has definitely helped us get deals over the line.
Thanks for that, David. Moving on to what I was talking about a little bit earlier with the revitalisation of the high street, which I think many would argue was definitely needed, especially as we've seen a huge surge in online shopping over the last 12 to 18 months, which was always going to come. It just accelerated that. How are different regions reacting to new requirements for commercial real estate, with that as the backdrop, especially considering it's still quite early and we're not quite sure what's going to happen in terms of footfall and what people require and how they're going to act. Andy, what are you seeing in your neck of the woods?
Thanks, Beth. Well, I suppose the best example would be the St James's Quarter in Edinburgh, which is a £1 billion mixed-use development. I think there's 850,000 square feet of retail space, 30 restaurants, cinema, hotel, and that's all being built at the east end of Princess Street. Traditionally, the prime pitch is Princess Street, so that's obviously going to draw quite a bit of the occupying demand away from Princess Street, and we've seen that already with Johnny Walker Visitor Centre opening up at the west end of Princess Street, and there's been quite a few deals recently between what were formerly retail units on Castle Street and on Princess Street turning into restaurants. There's a second whisky experience coming in just around the corner from the Johnny Walker site. So we're seeing more of that kind of leisure side coming into the city centre. So more restaurants, I think, in the West End as well. So I think that'll just change the retail focus away from Princess Street and towards St James's Quarter. St James's Quarter only opened a couple of weeks ago, and it's had quite good feedback so far. So I think that's a prime example of just exacerbating that footfall issue, moving everyone to one specific part of town, and then the West End not falling apart, just reinventing itself as something else, more leisure focused. And I think we'll probably see more of that going on.
Jason, are you seeing similar trends in terms of more leisure and restaurants rather than retail in Northern Ireland?
Yeah, we're not seeing as much speculative development activity in relation to the retail sector. I think people are a little bit looking at the portfolios, certainly the banks that are perhaps overexposed in their lending, retail investment sector for shopping centres and retail parks. But in terms of stock that's been brought to the market, 2021 already has been very exciting. We brought on a retail park, the primary bulky goods retail park in Northern Ireland, Shein Retail Park on Boucher Road. It's agreed for sale now, in and around the 23 million mark. It was brought on at an initial yield of it was 11.5%, and it's agreed sub 10%. There were 10 active bidders on that bid it up to that price, so you had a competitive bidding situation for a retail warehouse park. Whilst we're still, in the midst of COVID, I suppose. The other one was a shopping centre. Shopping centre has been notoriously difficult across the whole of the UK, as I understand, because of the challenge of sustainable rent flow and the overhead costs and the landlord shortfalls that are required to undertake. But again, Fairhill Shopping Centre, which is the primary shopping centre in Ballymena, we brought it on, and it's also agreed for sale at the moment. Probably one of the other ones that we weren't involved with was Merchant Square, which PwC bought. It's the biggest office development they have built outside of London. It's in the heart of the city centre, and I think it was a Middle Eastern investor bought that for 87 million and completed on it in Q1 in 2021. So that speaks volumes about the commitment to go ahead with those sort of deals that were in the pipeline during COVID. It's a 200,000 square foot office building with ground floor retail, and PwC are committing to coming back to work in the city centre. And I know that that's a question that's in everyone's minds. How is the office sector going to be resilient to this? Well, I think when you've got one of the biggest employers, certainly in the UK, there that is committing to that sort of level of space, they've signed up to a long-term lease on that property, and they want to be in the heart of the activity with their clients, surrounded by the main banks that are on the square of Donegal Square in Belfast. And I think the representation there for a company of that scale and calibre, they need to be in the city centre and working from home. Yes, it's an option, but I think in terms of growing the business, they've got to be out tramping the pavement and meeting their clients on a regular basis, as do we as surveyors, and as do bankers trying to win new business, I believe.
Definitely, and that is something we're seeing, I think, in other regions as well. Will, what's the biggest change you're seeing so far in terms of commercial assets in Manchester?
Well, I'll touch on something that perhaps nobody's yet touched on, and that's the real demand for industrial space at the moment. And that's really been driven by, I suppose, a couple of factors: the shortage of space generally, because there's been very little spec developments delivering new space over the years, and secondly, the shift to online retail. So across the whole spectrum, large distribution sheds over 200,000 square feet in real high demand on the motorway junctions, right down to 20 and 30,000 square foot last mile delivery units within the built up areas, and operators trying to get that space so they can get their vans close to their customers. And the real notable thing we have seen, I suppose, is how rents in industrial are driven forward, and that in turn, with that anticipation of continued rental growth, whether it'll continue or not is a different matter, but there's that expectation there amongst investors. And that's why investors are paying yields of 4%, and in some cases high threes for industrial investments. And that is historically been the reserve of the prime high street retail. And it's really been a shift, almost a total shift from retail yields now higher digits and industrial at lower digits, primarily because of the way that retail is distributed to consumers. So that's one notable thing I've noticed in the Northwest. And the other thing, just going back to our residential developments, I'll touch on it briefly because we've discussed it already, but the real demand for out of town traditional family housing from both developers wanting to sell to end purchasers, but also developers wanting to build traditional out of town housing for buy to let. And there are full estates now being developed out by funds who are letting them to private occupiers. So two areas. I could talk about retail and office, but I'll let someone else have an opportunity to speak.
Thanks for that, Will. And I've definitely seen a big rise in the build to rent space, and that seems to be quite a an accelerating market there, even though it's still quite young in its evolution. James, what would you say are the biggest differences you were seeing in the overall real estate market compared to pre-pandemic? And do you think investors are having to get a bit more creative?
Yeah, I think the biggest difference is I guess the lack of overseas buyers at the moment has made a big difference to the market. I think yields are for prime London are probably sort of around the 3.5%, 4%, depending on the asset. What we are seeing is a good demand for residential blocks, which are sort of freehold blocks, which could be blocks of sort of 8, 10 units, because actually they don't that often come to the market. So there is good demand from sort of smaller, mid-sized investors for that. I think a lot of investors are waiting to see what happens over the next sort of 3-4 months, as to whether we're sort of out of this or when we'll be out of this. And I think that we'll probably see more activity in the investor market, certainly coming in for the new build schemes in central London. Again, the investor market is very much driven depending on where the capital value sort of sits. Historically, the investor demand has been for properties in London up to sort of 750k, that sort of level. You do get investors at 2 to 3 million, but I think at the moment when they can't actually see the properties, I think there's some reluctancy to actually make a decision and to invest. So I mean, we are seeing, there does seem to be signs of increasing activity, which is a positive. But I go back to saying that definitely the demand at the moment, what we have seen the change is this demand for anywhere with outside space, which is obviously difficult to find in central London at the best of times. Hence, I'll go back to Notting Hill, where you've got the houses which go into the communal gardens at the back. They're highly sought after. And a lot of these have been bought by domestic buyers or overseas, but domiciled in the UK. And they're taking a very much longer term view. So this is not a sort of short term investment. They'll be prepared to spend money doing the property up, spend 18 months doing it up, because they see that as it is a long term investment, but they could be there for 15, 20 years, their children going to local schools. So that's, I think, really where the demand has sort of strengthened. And that's where the prices have been pretty strong. I think from a London market point of view, we did see quite a few price falls between 2015 to 2001, really up until now, where the market came off sort of 20 to 25%. I think in some ways that's been favourable, the fact that we probably saw that gradual price fall. The prices then came to sort of one could say, inverted commas, affordable level. And I think that's probably why the market has held, after having that sort of correction historically. So I think yields are not overly attractive at the moment. On single assets, you can be down at gross yields of sort of 2.6, 2.7, 2.75% on a gross basis. So I think the demand for buying single assets, one has to buy at any level, which makes it work with all your acquisition costs, etc. So whether we see investors taking a slightly more long-term view going forward, I think it'll be interesting, and I think we could well see that.
Thanks for that, James. Some really interesting points there, especially around the kind of changing, the shift in domestic and overseas investment in prime London. So I'll be interested to see if that continues. Jon, what are you seeing in terms of your clients getting a bit more creative, especially as you're in that hospitality and leisure industry?
Yeah, I mean, we've always, and it seems a funny thing to say when you're on a call with valuation experts, but the valuation has always for us been it's a really important part of the analysis, but it's probably not the most important part of the analysis. The most important part is fundamentally the borrower, and it's looking at their experience, and it's saying, and we've made a play of this years ago, and I remember writing articles for Bridging Commercial back in 2013, where we were trying to explain to people why it is that we get comfortable lending on pubs, which everyone said at the time was nuts, and some people still do. Is we were saying to people, we were saying to our borrowers, right, things go wrong. We've all seen this. Certainly everyone on this call and many other people were there in the big crash, and you can never predict what's going to happen with your asset values. What you can predict, though, I think more accurately, is this the sort of person who will be grown up, who will be brave, and who will make the difficult decisions, and who will find solutions, and who will work with you? And we're applying that across the board now, just like we always do. So, when people are coming to us and they're being opportunistic, it depends sort of what sorts of things they're being opportunistic about. So if they're saying, look, I really think there could be a strong recovery in the leisure sector because people's behaviours are changing, and maybe people are going to use their leisure assets more because they thought for a while that, well, they were certainly taken away from them in the sense that they couldn't go, then we're saying, great, that seems like a good opportunity. You seem to have the experience. What are you going to do if it goes wrong? And we're looking really closely at that. Same with out of town industrial warehouses. It's something that we've been quite positive about, again, because of all the change in deliveries. It's perhaps the counter, and I'm the only person on this call here who isn't a valuer, so I have to be careful I don't overstep my expertise, which isn't very high level of expertise. But you're sort of saying, is that the counter cycle to the problems in retail? Is that you're going to have more demand for distribution and stuff like that? So we're definitely buying into our clients' plans and our clients' ideas, because that's what we're all about. And the early stage development product is ideal for that. So we're saying to people, right, you've got this idea, you've got this concept, you're putting some money into it. We'll give you up to 3 years to make it work. But we're definitely focusing more on backup plans now, because that's why our book has performed so well during the pandemic. Is that when the pandemic hit, and when we made those phone calls, just like every lender would have done when the pandemic hit, and we said, well, we don't know where this is going to go, we don't know what's going to happen, what's your plan? What we got on the end of the phone were loads of really sensible, experienced people who had a plan. And that's why they've performed so well. We didn't have to sit there and say, well, you know what, we're at this LTV, therefore we should be okay because it's clearly going to go wrong, and they have no backup plan. So in terms of opportunities, there are absolutely loads of them. Clients are coming to us all the time with really interesting opportunities, down to, these city centre retails, a great opportunity for people to go for residential permissions and stuff like that. But we'll always be the same. We'll always say to the person, right, we know what the asset is, we'll get that valued, and we'll speak to our own experts about that. Let's talk about you. Let's talk about how you've handled adversity before. Let's talk about how you would, approach a difficult situation. Are you the sort of person who can accept, firstly, that you're not going to make as much money as you thought and do the sensible thing? Are you going to be able to handle the idea of not making any money at all and still do the right thing? Are you going to be able to handle the idea of potentially losing your equity and still do the right thing? And that's I would say that's 3/4 of our analysis. Even though we're sitting here on a call with valuers who are massively important to us as well.
Thanks for that, Jon. You made some really, really interesting points there, really playing into the story behind certain deals. And it's not just about the value, it is about their plans and experience, and the the sectors where there's perceived higher risk, like in leisure and tourism and hospitality. They're the ones who do have these plans A, B, C, D, whereas in the straightforward residential sectors, there's almost this feel of everyone being quite comfortable there. So it's really interesting, and it does set you up for having backup plans, and for if something like the pandemic comes along. So really interesting points there. Thanks for that, Jon. I'm interested to know, we've talked a bit about this race for space and looking at areas where you've got some outdoor areas, especially in city centres, if people are moving slightly outwards, and also we've got the government support schemes ending soon. We've got furlough ending later in the year, and we're likely to see tenants being pushed out by economic uncertainty. We're also seeing changes in how we commute. People are driving or cycling in rather than getting on trains, and also the flexible working is also impacting that. We also saw the flexible train fares introduced, which is really showing that's happening. So Andy, what are you seeing in terms of city centre real estate investment evolving as a result of all of those things that are happening right now?
Yes, it's difficult. I think we're at the early stages of that. I mean, Scotland doesn't open back up fully back to work until the 9th of August. So it's only when that comes along we'll start to see how that unfolds. So certainly, we've taken quite a relaxed view about working from home. It's worked perfectly well for us over the last 18 months. But some of the bigger deals that have been done, Bailey Gifford took 280,000 square feet at the Haymarket development. They signed a lease for 20 years to 280,000 square feet of office space. This was Q3 last year. There's quite a big statement that they're planning on still having everyone in their office. So I think there'll be a bit of time just to settle that down. I can see there being more demand for smaller office space. more flexible office space. So rather than having everyone in, perhaps it's 2 days at home and 3 days in the office. So I certainly see that coming along. Service office space market I can see doing well in the next wee while, but I think it'll take a bit of time for that to settle down. There'll be no shortage of demand to convert office space back into residential, certainly in the traditional stuff. This residential market in Edinburgh is still quite strong. It's strong in Glasgow, so I can see that happening quite quickly. So yeah, I think we'll really watch that unfold over the course of the next 12 months. That makes sense.
Just to pick up on what a comment Andy made there about regional office centres coming back. What we've noticed in Manchester, only in the last couple of weeks, is tenant activity has really picked up in terms of inquiry levels, and our office agents are really taking many more inquiries now about space requirements than they were 2-3 months ago. And one of the, a couple of core things that tenants in particular are looking for, they're looking for collaboration space in their office space. So the typical large open plan, relatively bland floor plates, they're looking to have collaboration space built into those floor plates. And they're also looking for what they're saying is core and flex. They're looking for a core amount of space that they can commit to a lease, but a landlord which can also offer them that flexible space as well. So if in 12 or 18 months' time they've got another 20% of their staff back in the office, they can easily find that additional space in the building. And evidence of that is one of the big four accountancy practices have just been moved out by the Colliers agency team of spinning 70,000 square feet in Spinningfields, which was shiny glass box office space, and they've moved out into a grade 2 listed building, Hanover building, which has got cast iron columns, it's got quirky meeting rooms, it's got unusual features. And what the tenant there wants is a space which really attracts and is attractive to their staff. And that's what they're trying to find in the city at the moment.
Thanks for that, Will. David, what are you seeing in terms of new patterns of working, living, which get settled if they do? And how do you think they are impacting both city centre and suburban hospitality and leisure assets?
Yeah, I'm probably in the camp of sort of believing that people will come back to city centres. I think, certainly speaking from my own personal experience, I very much enjoyed getting back into the office. I know I'm not in the office today, but given the chance, I absolutely, want to be there. And I get the feeling that from a lot of people that I've spoken to over the past sort of month or so, feel the same. I think it's reinvigorated a lot of people being back in, being around your colleagues, making quicker decisions. I think although, sort of Microsoft Teams, Zoom is great, I don't think it makes up for one-on-one interaction for decision making. So I think we will see quite a lot of people come back into the city centres. Yes, there probably will be this element of sort of flexible working, whether that's people coming in sort of 3 days a week, 4 days a week, and I guess where that will boost people where they live, because if they're spending more time there, then obviously they need the amenities to have that longer period of time at their home, and that may well create investment opportunity into those sort of local areas, especially with space generally being at a premium for a lot of developers. And areas like London, which are hugely developed, they've got to look to the commuter towns, and when the commuter towns start to reach capacity, I guess they've then got to look a bit further out as well for space. And as I said earlier on the call, I'm probably fitting into that category of one of those people who is moving into those sorts of areas, and I can certainly see huge amounts of development in those locations, and areas that fundamentally at the moment are predominantly residential, but after that you're going to see your coffee shops come into play, you're going to see your local supermarkets, and more investment going to those towns as there's more people to spend money in those locations, and that will create, you know, lending opportunities for us at Ortus as well.
I also think, it's Jon Salisbury, if I could just step in as well. I think there are certain things in the press about like work from home or work from the office. There are certain big employers that hit the headlines. So someone like Goldman Sachs says, oh, we're bringing everybody back, or someone like, I don't know, Twitter says, oh, no one has to come back at all. And it's important to remember that these are just specific employers with a big profile, right? So they hit the press, and everyone thinks that that's an indicator that everyone's going to come back, or nobody's going to come back. And I think that we just have to wait and see, because a lot of it will be employee led. You interview somebody and you want to hire them, and then you have that conversation, and people, you often, and this was happening even before the pandemic, is that those conversations were increasingly happening about flexible working, about family commitments, dropping the kids off, picking the kids up, you know, doing whatever with male and female employees. And those conversations were happening anyway. It's just an extension of that. And I know this is a bit of a cliche, everyone said, but I think we would have ended up here anyway. IT has improved, but I don't think for a moment that we're going to have a situation where everyone's going to work from home. I just don't think that works. And I don't think anyone really, when they think about it, thinks it works. It works for introverts within an organization who maybe, or people doing very specific jobs. But it feels to me like we're heading towards a hybrid. And people are going to value their time in the office significantly more than they did, and maybe people will work sufficiently, maybe people will work more efficiently. There will, however, be a sting in the tail, and in the, you know, being in the office for long hours has been a long-standing way of people impressing. And with that, if that gets taken away, then there'll simply be other ways that people will try and impress, and it'll be really interesting to see how that pans out. It's like an organism. It will just evolve into a different shape, and it will be really interesting to see how it goes, because ultimately, you know, staff will compete with each other to show their commitments, and it'll be interesting to see how people do that in environments where the FaceTime culture is removed.
A really good point there, and I think for like you said, this shift is something which I think everyone has expected to see anyway, but the pandemic's just accelerated that. But we've seen for quite a while that you know, employees and employers are saying, you know, time spent on something isn't always the best you know, proof of good work and commitment. It's really the productivity of that, and I think we're actually now kind of moving into that space where that's going to be the thing. So it will be really interesting to see how that changes the way that people work. James, I just wanted to ask on the tail end of that. Obviously, we're very likely to see kind of flexible working continue. We might not see remote working become the staple, but flexible to an extent is going to be quite rife and continuing. How will this impact city centre and suburban areas? Because for example, if you've got people who are coming in on Tuesday, Wednesday, Thursday, but having Monday and Friday at home, that's going to vastly change the kind of after work experience, where you see lots of people in pubs and restaurants, you know, spilling out onto pavements. So what are you seeing, and what do you kind of expect to change in that respect?
Yeah, I think general feeling is that I can only talk for myself and my team, but I think, you know, people do like to collaborate. They do like to be in the office together. You know, I think by nature people are social people, and I think also in terms of almost teaching and developing staff, I think it's very difficult to do that remotely. I think, you know, from graduates through, I think you know an awful lot by listening to conversations which other staff members are having. I think if you don't have that, I think taking a longer term view, how do you develop your staff to the best, I think is one of the issues. So, you know, I see a view that I think, you know, it is, you know, a lot of people enjoy working from home, but, you know, after 18 months, I can talk for myself, it's, you know, it is quite nice to socialise and, you know, to actually go to the pub again. So I think the impact could be potentially on you know, on restaurants, and certainly in central London, coffee bars. which is so heavily reliant on footfall, on people going back to the offices in city centres. And I think the concern is what's going to happen to them going forward. So I can see the government are going to be quite keen to get people going back to the offices, in order to help with all the knock-on effect that by working from home has on all those other sectors. So I can see a collaboration. I think every business operates in a different way, and obviously, doing different jobs. Some where you need to be in the office more than others. So I think it's going to be fun. I think each business will take a view going forward, and that will be driven by, if you're looking to retain staff, I think that's one thing. Is that what you're going to need to offer them to retain them, and also to attract staff? It's the same thing. Is if you want to attract staff, do you need to offer them that flexibility as well? So I think most businesses are still finding their feet to a certain extent, and it may take a little while before it all settles down. But I can certainly see a balance between the two.
Brilliant, thank you. I'm just going to ask one more question just for the whole panel, so anyone who wants to answer this one. What would you say now is the area for investment of choice? Like what sector or asset type? What do you think really is trending right now and the investment of choice?
I think, Beth, from a Northern Ireland perspective, certainly I think William mentioned it earlier, the end of the line, last mile logistics sector is very hot at the moment. We sold an Amazon investment in Q4 2020. It wasn't just as strong a yields as you're seeing, William, but we were at 5.5% on that. It was a pre-let to Amazon, but it was brilliant. It was right in the heart of the pandemic, and good bidding on that as well. I think that's very strong, and there are a few speculative developments in that logistics sector that's coming out. I think supply chain for Northern Ireland is a massive issue, and I think being able to have the free flow of products, certainly between the north and the south of Ireland, those sort of last mile logistical and distribution centres are going to be very hot going forward. I think the market, there's no doubt it has accelerated moving towards internet shopping, and that means more deliveries like Amazon, the DPDs of this world, all those UPS. That's a growth sector that's probably only going to continue over the short term, I would think.
Would anyone else?
I think one of the other areas actually that you see, or we've certainly seen grow over the last few years, is the care sector as well, because it's just got sort of strong fundamentals of, at the end of the day, we've got an aging population, and people need care as they get older, and I think those are solid fundamentals that will just continue to remain. So I think you'll see areas of growth like that. The other one is also fundamentally residential, and I think not only do people look for growth, but they also look for safety. And again, you've got strong fundamentals of, at the bottom line, we all need places to live, and that's something that won't change either. So not only do investors always look for growth, but they also look for certainty, and I think you get that with something like residential.
Thanks for that, David. We are now at 2 minutes past 12, so I'm going to have to kindly bring today's event to a close. I just want to thank Ortus for partnering with us on this discussion, and also thanks very much to our fantastic expert panel for taking time out of your busy schedules to be here. And I also want to thank you, our audience, for joining us. We will be publishing this roundtable in full on BNC next week for those of you that weren't able to make today's live event. We will also have a write-up of the highlights as well for you to enjoy. And if you enjoyed this one, please do check out our virtual roundtable events calendar on BNC. We are holding events every week this year. And also, for more insight and news on the specialist finance sector, please subscribe for free to the Print, Bridging and Commercial magazine. Have a fantastic afternoon, everyone. The sun is still shining, so definitely get some sun today. And we hope to see more of you in person soon. Thank you very much.